Last week, we saw 3 straight days of M&A announcements within the mining sector, and this week appears to be off to a similar start. On Sunday evening, Mandalay Resources announced that they would be partaking in a merger with that of ASX-listed Alkane Resources, starting off a second straight week of M&A activity within the gold space. But unlike some of the transactions announced last week, this one doesn't sound all that enticing for shareholders. Let's dive in. Officially billed as a merger of equals, the bringing together of Mandalay and Alkane is being pushed by the two management teams as an arrangement whereby bigger means better. The transaction as currently proposed will basically see Mandalay absorbed by Alkane in an effort to create a larger gold and antimony producer that is predominantly focused on Australia. The two parties on a combined basis operate 3 mines, which are expected to produce a collective 160,000 ounces of gold equivalent this year. This enhanced production profile for Alkane, alongside a pro forma market capitalization of 898 million Canadian dollars, is said to be enough to drive a potential valuation re-rate that is driven by the GDXJ VanEck Junior Gold Miners ETF, as well as by a potential inclusion in the ASX 300 index, both of which allocate weightings based on market cap, i.e., the bigger the market cap, the more the indexes own, while further value is claimed to come from enhanced liquidity, a larger float, and a more diverse shareholder base. For Mandalay shareholders, they'll come away with the deal with a 55% ownership stake in the resulting company, which will be primarily listed on the ASX rather than the TSX. Alkane has said they will apply for a TSX listing, but there's not a firm timeline for that as of yet. Post-transaction, the refreshed Alkane is expected to be led by their current managing director, Nick Erner, alongside their current CFO, James Carter. Mandalay's COO, Ryan Osterberry, and VP of Exploration, Chris Davis, meanwhile, will join the senior management team to provide continuity for Mandalay's 2 mines being brought into the mix. The board, meanwhile, will have 3 nominees from Mandalay, 2 from Alkane, and will be helmed by an independent chair, Andy Quinn, who is currently a director for Barrick Gold, a role which he is retiring from in May. Okay, so let's get into the terms of the deal here. Under the terms of the arrangement, Mandalay shareholders will receive 7.875 shares of Alkane for each share of Mandalay held, which equates to about a 2% premium. And on a 20-day volume-weighted average price basis, it's actually a 6% discount. The transaction, of course, remains subject to shareholder approval, with Mandalay requiring 66 2/3 of their shareholders to approve the deal, while Alkane needs a simple majority of their shareholders to support the required issuance of shares. So far, Mandalay's management, alongside major shareholders CE Mining and GMT Capital, who collectively own 45% of the company, have entered into voting support agreements for the transaction, while Alkane has secured voting support from 19% of their outstanding shares. A termination fee of 17 million Australian dollars, meanwhile, is in play with the deal, with the entire thing expected to be wrapped up in the 3rd quarter. By now, investors that aren't involved in either name are probably wondering what is even being brought together here. So let's take a look at that. Mandalay Resources brings to the table 2 operating mines, the Costerfield Underground Gold and Antimony Mine in Australia, and the Björkdal Underground Gold Mine in Sweden. These assets are pretty key here. First, Björkdal is expected to produce 42,000 to 46,000 ounces of gold this year. Costerfield, meanwhile, will produce 44,000 to 49,000 ounces of gold equivalent. And it's the only antimony mine in all of Australia, which is pretty significant in this geopolitical climate. Alkane, meanwhile, brings the Temmingley gold mine in Australia, as well as the nearby Boda Kaiser project with 9.8 million ounces of gold equivalent measured and indicated. Temmingley is expected to produce 70,000 to 80,000 ounces of gold this year, but is nearing the end of a recent expansion that will grow production beginning in 2026. Combined, the assets are expected to produce roughly 160,000 ounces of gold equivalent this year at an all-in sustaining cost of about $1,760 an ounce. That production will get a bump up next year to about 180,000 ounces, while AISC is expected to fall to around $1,420 an ounce. It should also be noted here that Mandalay has about $122 million in cash on the books and no debt, while Alkane has $45 million in cash and $53 million in debt. Pro forma, that equates to $167 million in cash and $53 million in debt that the resulting company will be sitting with, leading to an enterprise value of about $784 million, assuming a market capitalization of 898 million Canadian. The big argument here for the entire arrangement appears to be the potential for a re-rate, driven by the GDXJ. And given the fact that Mandalay shareholders are taking a bit of a discount on a volume-weighted basis, we should probably address it since this seems to be their hope for a win in all this. To be clear, Alkane is currently included within VanEck's Junior Mining ETF. As of the most recent rebalancing, the company made up 0.15% of the ETF's net assets, with a total of 16.3 million shares held, which are worth about $7.8 million. To keep things simple, the weighted scheme behind the fund basically says that aside from the top 5 securities included in the list, every name included is assigned a weighting based on market capitalization. Post-merger, the company is expected to have a market cap of about 898 million Canadian dollars, which places them somewhere between Go Gold Resources and Discovery Silver in terms of weighting. That placement, using very rough math, would place Alkane at about 0.3% allocation of net assets, equivalent to somewhere between $14 and $19 million. Roughly speaking, in terms of the value of shares held. Following that line of thinking, that additional buying would increase the value of Alkane shares, which might be enough to find them a spot in the ASX 300. The ASX 300 is basically an index with the 300 largest publicly traded companies in Australia. Post-merger, in Australian dollars, the market capitalization of Alkane will be roughly $1 billion. The rough cutoff for the ASX 300, as per market index, is about $1.14 billion. But that list includes 39 ETFs that wouldn't be included within the ASX 300. So with the enhanced market cap from the transaction, plus the additional buying brought on by the GDXJ, and well, Alkane just might make it into the ASX 300, which would drive further buying and push up the equity, or re-rate it even further. At least that's what they're banking on. All right, so let's wrap it up. When it comes to M&A, investors typically think some sort of big payout is coming, whether that be in the form of cash or shares or whatever, with the underlying argument being that the transaction will result in massive synergies or a benefit to one shareholder group. But this transaction is different. Instead, it's premised on big market cap makes stock go up. And from our view, that isn't particularly enticing. If it is for you, well, good on you. But it seems like a lot of headache for the hope that something works out in the end. Maybe it appears more calculated for you. All right, everybody, thanks for watching. If you enjoyed this content, please smash that like button, subscribe, ring that notification bell. Also, guys, if you have thoughts on the transaction, let us know in the comment section. If there's stories you want us to cover, as always, I promise you, we read every comment. And if it works for our schedule, we will get to some of the suggested stories you guys have for us. Thanks for watching, everyone.